So you've probably noticed this problem as well. The S&P 500 is currently super expensive and has reached an all-time high. The Nasdaq is also looking pretty crazy, and even Canadian stocks have spiked up. So as an equities investor, where can you go to find reasonably priced companies when it seems like everything is so expensive? Well, how about emerging markets? Valuation-wise, companies in developing countries are about half as expensive as US counterparts. Emerging market stocks experienced a pullback this year, unlike US stocks. Maybe this is an opportunity to start a position in the EM market. So in today's video, I'm going to break down all the emerging markets ETF that's worth looking at to help you decide which fund is best for your portfolio. Hey guys, welcome back to the channel where I explain useful investing topics in concise videos. So let me first answer the question, what's the best emerging markets ETF? I think for the majority of retail investors like myself, the Vanguard FTSE Emerging Markets ETF, ticker symbol VWO, is the single best solution to your emerging markets needs. Here's why. It has an expense ratio of just 0.1% annually. That's the cheapest in the EM category. The fund size is about 110 billion, which is the largest fund of this type. And this creates a lot of liquidity and makes it easy to get in and out of. And finally, it holds over 5,000 companies, making it highly diversified and not concentrated in any particular sector or country. VWO trades on the New York Stock Exchange. Now, Vanguard has a Canadian version of the same ETF, which is VEE, and that's on the Toronto Stock Exchange. This allows Canadians to buy the same holdings without converting from Canadian to US dollars. So, if you're looking for a simple single ETF strategy to gain exposure to EM stocks, then you can't really go wrong with VWO, unless you're a big fan of South Korean brands. In that case, you might want to consider something like IEMG, the iShares Core MSCI Emerging Markets ETF. To understand what this fund is exactly, we need to look at its history. So in 2003, BlackRock launched EEM. It was the first ETF to offer investors direct exposure to emerging markets. It tracked the MSCI Emerging Markets Index, and at first it was the default choice for any investors looking to invest in EM stocks. The management fee was 0.77%, so it wasn't cheap for an index fund, but its monopoly was short-lived. In 2005, Vanguard launched its own EM index fund, VWO. This is the one we just talked about. At the time of debut, VWO had a management fee of 0.3%. Not as cheap as it is today, but it was still a lot cheaper than what BlackRock was offering. So over time, the Vanguard fund saw more inflows as investors naturally chose the lower cost ETF. This went on for years, but by 2012, BlackRock has had enough. They knew they had to come up with something new to stay relevant. My guess was the executives were brainstorming new ideas to stay competitive. They didn't like the idea of slashing fees on their existing fund, EEM, as doing so would cost the company millions of dollars in fee revenue. And that's when one person suggested, well, what if we just launch a new fund to compete directly with VWO while keeping the existing ETF fee structure unchanged? This way, they can have their cake and eat it too. So, BlackRock launched its new low cost core series of ETFs, and that's how the iShares Core MSCI Emerging Markets ETF was created. And it did pretty well. In just 5 years since its inception, IEMG saw $32 billion in net inflows. Meanwhile, the OG EEM experienced $2 billion in outflows. So both VWO and IEMG are low-cost index funds that track emerging market stocks. The performance has historically been about the same. So what's the difference between the two? Well, as the name suggests, for VWO, Vanguard uses the FTSE Emerging Markets All Cap China A Inclusion Index. Meanwhile, BlackRock uses the MSCI Emerging Markets Investable Market Index for IEMG. FTSE and MSCI are just different financial companies that create the list of holdings that index funds track, and they don't always agree on the same criteria. For example, FTSE doesn't consider South Korea to be an emerging market, but MSCI does. So the biggest difference between the two popular ETFs is that VWO, which tracks the FTSE index, doesn't have any exposure to South Korean stocks, but IEMG, which follows the MSCI index, does. So if you want an emerging markets fund that gives you some Korean stocks like Samsung or SK Hynix, a semiconductor company, then you should consider iShares Core MSCI Emerging Markets ETF. By the way, the Canadian version of IEMG is XEC. the iShares Core MSCI Emerging Markets IMI Index ETF. This is basically the same as the US-based IEMG ETF, but wrapped in a Canadian package, so you can buy it in Canadian dollars. Just be aware that the MER will be a bit higher on XCC due to the added complexity, and you also have to pay a slightly higher spread when making trades because of less liquidity compared to the original US dollar-based IEMG. So just keep that in mind, and the same applies to the Canadian VEE wrap of VWO. By the way, you can always pair up VWO with a developed market ETF, such as VEA, to still get that South Korea exposure. But then you might be overcomplicating your portfolio, so you might want to just consider sticking with a simpler global all-in-one index fund like VEQT or XEQT. There are also some unique emerging market ETFs that we can quickly go over, and then I can share what I'm doing with EM funds in my own portfolio. If you can't really stomach high volatility, but you still want exposure to emerging markets, you can consider the iShares MSCI Emerging Markets Minimum Volatility Factor ETF. I wouldn't buy this one myself as a long-term investor because it would fail to capture a lot of the upside in the market over time. If you're investing with a dividend focus, then you might want to consider the Schwab EM Equity ETF. This is comparable to VWO, except it has companies that pay higher dividends, so you're going to get more distributions rather than capital appreciation. For me, total return matters the most, but I can see in some situations why this might be better for someone. Historically speaking, small cap stocks have outperformed large cap. So if you want a small cap tilt in your emerging markets portfolio, you can consider EEMS or DGS. And at least over the last year, they seem to have done quite well. Most emerging market ETFs put a large focus on China, but if you're worried about policy risk or have other concerns about China specifically, then you can consider the iShares MSCI Emerging Markets ex-China ETF. This fund lets you invest in all emerging markets except Chinese companies. Chinese stocks have underperformed so far this year. This ETF has been doing quite well over the last bit. One of the greatest advantages of these emerging markets funds is their diversification benefit. They all have a lower correlation to the US stock market than international developed countries. Compared to developed markets, emerging market stocks are selling at a discount, but of course there's a reason for that. EM stocks come with additional risks, including political instability, infrastructure issues, and market inefficiencies. But keep in mind that these risks will eventually subside as emerging markets grow into developed ones. EM currently comprise around 10% of the global stock market, and they have a lot more potential to grow relative to developed markets. So, how am I buying emerging market ETFs? I always like to compare what's happening right now with historical valuations. Compared to the last 5 years, it looks like emerging market stocks are not particularly cheap, just based on the price to earnings and price to book ratios. So instead of buying emerging market funds at the current price today, I have sold put options to buy them if they fall further in the future. The ETF I like to use for this strategy is VWO for the robust options chain and high liquidity. So earlier this month, for example, I sold two VWO put options with a strike price of $46. What this basically means is I collected $70 in option premiums, and I only have to buy VWO if it drops 10% or more by October. Once the option expires, I'm just going to write more put options. This method guarantees that I only buy this emerging market ETF at a discount to today's price, and I get to earn some income along the way. I will continue to use this strategy to buy VWO until it makes up about 10 to 15% of my overall stock portfolio. I made a video previously sharing how I determine which options to sell. You can check it out here if you want to see a step-by-step demonstration. Thanks a lot for watching. I hope you enjoyed this video and got something out of it. Until next time.